Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time on September the 18th, and Brent crude oil is trading at the robust up again this morning, 94.50 and change. The exactly what is it, 94.65, so up nearly 1% already in early trade in Asia. Let's welcome, as always, Omar Najia, Global Head of Derivatives at BB Energy. Omar, we're $4 up from where we were when we last talked a week ago. Market closed on last Monday at 90 and change. Now it's banging on 95. Anything to stop this trend?
I think what's changed now is nobody's talking about China anymore, right? So we've had all this, China this, China that. So it's as usual. Oil markets, I think, run on sentiment and the narrative that was trying to be, put in place is that China's going to melt down and China's going to I don't know what, and oil prices keep going higher. So the conclusion that I come to is China has nothing to do with the oil price, surprisingly, right? So I think this market is going to head considerably higher. I think that nothing goes up in a straight line, so don't be surprised if we pull back. But at the end of the day, you have a world where, how can I put it, winter is coming, which again surprises a lot of people. You have the fact that OPEC Plus is not only holding together, because we heard a lot about, they can't do this and I don't know what, blah, blah, but they're holding together. They seem to be looking after their own interests, which again surprises a lot of people. So I think robustly higher. I think it's not just an oil story, it's going to be a commodity story. People were quite confident in saying, inflation's going to come off and all that kind of stuff. And inflation's ticking up in Europe. It's ticking up in the States. So it's quite interesting. So I think the conclusion that I come to is macro does not drive the oil price. So when people say, the economy is this and I don't know what, it's got nothing to do with it. Macro doesn't even drive the S&P. Right? So I think higher and robustly so. You'll have pullbacks along the way. So, it's not basically buy now and wait till we get to, 150. But I think the direction of travel is higher. And I think basically, they say, who said basically bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I think we're at the skepticism phase because everybody's like, oh no, it's gone high, and yeah. So we're still skepticism. So I think lots of surprises yet to come.
Kate Durian, Meese contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington, D.C. Kate, it seems in some ways the major agencies that are at the gateway of the oil markets don't quite know which stage of that I don't know, was it sort of the grief stages that Omar put out there? But we saw a bit last week an incredible discrepancy between OPEC forecasting a 3 million barrel a day supply shortfall in the fourth quarter. The IEA, your former employer, forecasting a 1.5 million barrel a day shortfall, half of the OPEC, and then way back, so far back you can't really see it, but nonetheless, the most, I suppose, bearish in some regards is the EIA forecasting only a 230,000 barrel a day shortfall in supply in the fourth quarter. Your thoughts, firstly, on how could we have such a discrepancy and what's the consequences of that discrepancy?
It is very unusual to see such a huge discrepancy. I mean, usually it's about 100,000 barrels, but not much more than that. And, they do have OPEC and IEA, despite the tensions that have arisen over the prediction by the IEA that oil demand is going to peak. Fossil fuel demand is going to peak before the end of the decade. They do still, do exchange information and technical meetings and so on. So yeah, it is a very strange, but the fact remains that both these organizations, I mean, at least the IEA and OPEC, they all expected the market to tighten in the second half. Yet we saw these production cuts, voluntary cut by Saudi Arabia, and I think that's what's driving this price spike. So if you look at fundamentals, you would expect that there should be more supply, and OPEC isn't going to look at the IEA, they're going to look at their own numbers. And we were expecting the Saudi oil minister to speak later today at the World Petroleum Congress. So I don't think he's going to give us much indication. He's already said it. We've given you guidance. We're going to maintain these cuts until the end of the year. So I agree with Omar that there's no way the price is going to come off. A 0.25% increase in interest rates in the US isn't really going to push the needle. Very much. You've got China, but yes, expected slower growth in China. But again, Chinese economy has changed, and what we should really be looking at is the products market, particularly diesel.
Well, Richard Rigoglia, CEO of Matrix Global Holdings, will stick with the crude narrative before getting to diesel, which is clearly very interesting, and that's where the rubber meets the road, so to speak. But Richard, which of those three numbers would you expect the Saudi oil minister to follow in the fourth quarter? His own OPEC plus forecast of 3 million barrels a day shortfall in supply, or the EIA at only 230,000 and the IEA in the middle? Your thoughts on which one of those he should or will follow?
Well, he'll follow the one that gives him the highest price. Right? Isn't that what you do? Is that what you do with markets? We're reaping what we are sowing. We're ignoring the effect of a rush to transition. I think Omar said it right. This is not macroeconomics. This is the realization that the governments are in control. The IEA and the EIA are instruments of the government, and they are going to say what they want to say, and they're going to dictate that. I was fooled early on in my life by a thing called peak oil theory. And peak oil theory was that oil production would peak, given called Hubert peak, and that was in the 90s. And I was fooled by that. I believe now we're trying to get fooled by peak oil demand theory now. And I think that's the next one. The IEA has come out now a couple times and said there's going to be peak oil demand. I'm coining the new phrase, peak renewable hype theory. And I think we're getting towards the peak renewable hype theory, where people are starting to realize, by ignoring the rational concept, proven concept of price discovery, which leads us to rebalancing of supply demand through the simple fact of a thing called supply demand economics, which causes supply to increase when prices increase. When you lose that, and instead you make a decision where governments dictate what supply and demand is going to be, you run into a real big problem. And I think that problem is going to show up around the world. Here on this call, everyone listening, we're all going to be fine. Where we live lovely lives, we travel around the world on jets, and we live lovely lives. The middle and lower class countries of the world are going to suffer mightily. I think we're finding ourselves in a situation where we are stressing we're stressing it now. Biden cut off the most prolific area in the Alaskan North Slope. So we have 4 million acres there that aren't going to be produced, which is a supply. The U.S. Gulf Coast is being cut off. So we're all talking about a hydrocarbon-free future, when in fact we need hydrocarbons. And I went back and listened to, we've been doing this, and I do appreciate doing this, Sean. This has been enlightening for me to do this for so many years now. I went back and listened to something I said about a year and a half ago, and that was, the problem wasn't 21. The problem wasn't 22. The problem is going to be from the middle of 23 to 26. When demand starts to rise, OPEC says enough is enough. You've told us you don't want our oil. We're going to control the switch. Information technology is not perfect, but it's pretty darn good. And they're going to be able to calculate what demand is. And they're going to take their little doll and they're going to say, you know what? I'm going from 9.5 to 9.2 to 8.7 to 8.6. Oh, the price is up. That's just too darn bad, because you're telling us you don't want our oil down the road. So I think we're in for a very rough ride. I agree with Omar that we're going to have ups and downs. I've watched commodity markets my entire life. We could have a $7 downdraft at any point in time. But I think this market is on a road to much higher prices. I think inflation is going to come back with a vengeance. Interest rates are going to have to stay high. And here's a note I think we can talk about when we look at California. If interest rates fall in California by to 2%. Housing prices are going to go through the absolute roof. And when housing prices go through the roof, so too rents. And there you're going to have a double and triple whammy: high energy prices, high housing prices, and high rental prices. And we all own our own homes, I imagine, but I'm very, very concerned for the future. And we are just on the cusp of it right now.
Well, we have all those three here in Dubai already. Omar, I wanted to get your thoughts on the impact on volatility here of the discrepancy between these three forecasts in terms of supply shortfall in the fourth quarter. We've come through 2023, the first three quarters, when volatility in the oil markets has dropped dramatically through the three quarters, even with the oil price rising in the third quarter, 30+% now. Comparative to last year, we're kind of at half the volatility level. I'm wondering your outlook for volatility. I know the traders seem to like volatility because you can make lots of money. What's your outlook for volatility now moving forward, and the impact that these sort of forecasts for the shortage, if you like, will have on that?
I mean, volatility just means that price is setting new highs or new lows, right? Or breaking out of a range. So we haven't moved from the end of or the beginning of December 22 till about July this year. Market's been moving sideways in a range, which means low volatility. Market has broken that range, which means high volatility. So I think basically you should see volatility keep increasing because you're going to set new highs. Market's going to go higher, et cetera, et cetera. So, I mean, you know,
and is that a good or bad thing? Is it good for traders? Is it bad for them? What's your sense of greater volatility? Because the producers tend to dislike greater volatility.
Well, I mean, it really depends. I mean, producers like vol just means breaking out of a range. So if market's breaking out of a range and trending, producers love it. Okay, if markets breaking out of a range and going downwards, producers don't like it. But volatility is just, you know, prices breaking out of a range and, you know, trending, setting new ranges. So I don't think that we're going to go back into a low volatility kind of view. I don't think markets are going to move sideways. What you're seeing in oil markets is everybody selling their view. EIA, IEA, telling you everything's going to be okay, blah, blah, blah. You see the same for the Fed. They're selling you this stuff. Now, some people, because of the way they're built, they like to basically say, yeah, that's authority. So they must be truth tellers and put them on a pedestal and bow down and yes, yes, yes. I take the opposite view. I think basically that these institutions are trying to, I don't know what they're trying to do. They're not fooling anybody in the oil market. I don't know anybody who looks at EIA and IEA projections and stuff like that, honestly. But I think that, you know, for whatever reason, these markets are going to head. I basically agree with what Richard was saying. We're going to get head higher. I think it's going to be surprising for everybody. I think the overarching idea is that you've tried to keep commodity prices somewhere, and you've tried to keep financialization and financial prices somewhere else. And I think that balance has to redress, which would mean that a lot of, you know, resource-led economies against debt-led economies. And as we know, the West is so full of debt, is so magnificently full of debt, that it's going to be really interesting to see what happens next. If the Fed, who is buying US debt? The only people buying US debt are the Fed and US banks, which is why they're quote unquote in trouble, because they've been buying this debt at very, very low interest rates. And those interest rates have gone up, which means those assets are basically worthless. So all central banks, UAE, Saudi Arabia, China, Russia, have all been selling US debt, which again will put pressure on the dollar, which again will have implications for commodity markets to the upside.
Kate, while as Omar mentions there, that few maybe in the markets will be led by the IEA or the EIA. That's possibly true in areas, but they certainly follow OPEC. And OPEC Plus has been very clear about its strategy, at least stated publicly and repeatedly, is we are now a data-led organization. We are data-led policymakers. And yet we're facing a scenario here, perhaps, where they're not following their own forecast. Is it possible that OPEC could go through the fourth quarter, OPEC Plus, with their research department forecasting a 3 million barrel a day shortage, and the policymakers saying, yeah, we hear you, but we're not going to follow that guidance? I'm wondering the divergence there and what that consequence of that could be for the markets, who may say, well, we can no longer believe what they're telling us in terms of forward guidance. Your thoughts on that?
Yeah, well, the Saudi minister said he wants the speculators, the market, to start ouching because they've been, it's if you look at the fundamentals, you would assume that there is a need for more supply. So if you don't get more supply from OPEC when they meet again in November, I think it is, then you have to wonder whether it is an effort to get prices up, or if you want to be a bit more generous, to say, okay, they're actually looking ahead to the first quarter of 2024, when both the IEA and OPEC expect that the surplus will flip, that there won't be a surplus, that you will get that the market will be more balanced. So, if you look at it, and I think they want inventories to be drained. I think that's one of the main objectives of OPEC cuts, is to ensure that inventories don't build, because that also puts pressure on prices. And I think that's where both OPEC and the IEA expect inventories to sort of to start declining, and that demand will moderate. So I think that's probably where they're looking at, sort of looking ahead to 2024. More of a long-term play rather than a short-term looking month, on a monthly basis. And of course, all these projections, all these forecasts are subject to revision, and we've seen it time and time again.
Which is why one might leave out there for the possibility that OPEC Plus does perhaps react to their own research body that announced that 3 million deficit last week. Richard, looking forward from the US point of view and for central bank policy point of view, which of course is another part of this narrative, the ability or the attempt to try and constrain the interest rates, or constrain inflation by interest rates. Your thought, are we in the plateau? Is the US reached that plateau, or could we go further?
We're going to have to go further. We have to go back to what we just did. We just printed $3 trillion in the United States, let alone what China did, what everyone else did. So the money's been printed; it's still sitting there. We're seeing it here in California. I mean, California is a bellwether for the entire country, and market is. People talk about prices, higher prices all the time. It is still there. We still have inflation. So the Fed cannot take its foot off the pedal or off the neck of the market, however you want to put it. I think there's a real problem here, and I said before. Housing prices are just wanting to explode higher, and what's happening is the amount of houses on the market are the lowest they've ever been. The reason, though, the reason, I shouldn't say the lowest ever, but going back 35 years or so, and the reason for that is everyone who owns a home has a mortgage at 2.5%, and the last thing you can do, even if you can sell your house and make a lot of money, you have to move somewhere, and if you're going to move somewhere, you're probably going to need another mortgage. So mortgage prices have literally tripled. In 2020, I bought a house in February of 2020, thinking I made the worst decision of my life, only to have the price go up 80% and my mortgage go from 2.5% to 7%. Well, I'll keep it at 2.5% and be happy with that. And so the Fed knows this. They cannot let their gaze to wander. They have to make sure that they keep pressure on this. And that's just that part of the economy. I think this energy, what we're starting to see now, we're seeing it with the UAE. You can't make up what's going on. Kate, I think you made a good point. What is Saudi doing? Saudi is going to continue to do this until they can do this. They're going to keep the highest prices they can. They maximize their profit over the next 10 years. I think that has to be their goal. And however they do it, one of the ways to do it is to keep production, a handle on production. But we're also seeing it in other ways. The UAE now, which has always been the largest funder, one of the largest funders next after the teachers union to the Democratic Party, went on a strike with all 3 car companies. Why did it do that? Well, it did that because the energy policy of the United States is the energy transition, the Inflation Reduction Act, which, remember, is really an inflation act because it means that they have to pump money into all of these new cars that are being built. Well, what happens when you build a new electric car? You need 30% less people. And so we're seeing this in many different ways. It's happening kind of all across the spectrum. And to me, shows you the fallacies in the energy transition. You cannot have all these things and expect everything to turn out like it's supposed to. We spent 90 years setting up the infrastructure for oil. We're not going to have the energy transition in the next 10 to get rid of hydrocarbons. And so all of this is together. It's all one big stew that's boiling, and I don't think anybody has a handle on it.
Let's go to the survey question, which is sort of directed in this conversation. The discrepancy in forecasts for oil supply shortfall in Q4 between OPEC, IEA, and EIA will drive up volatility in the markets. Agree or disagree? And there might be many things that will drive it up, but ultimately the uncertainty of forecasting accelerates volatility is the thesis here. Agree or disagree? Omar, I wanted to come back to where we started, one of the early comments about diesel and distillates. We're seeing a big surge in diesel prices, up nearly 50% in the last number of months, alongside Brent, but more than. Your thoughts on what that tells us and the direction of travel for that as we move into the winter?
So again, I mean, it's not magic. I mean, I'm surprised. It's like everybody has the information, but nobody wants to look, right? So diesel prices are going up. Why? Because of sanctions. Why? Because basically you take the crude that all of Europe needs to make diesel, and you sanction it, right? So what happened to the what was it? The price cap, right? I mean, it's a total disaster. I mean, so it's like asking, why, if I put a gun to my head and I fire, why am I dead? I mean, I don't get it. Well, because you put the gun to your head and you fired. I mean, it's that simple. It's beyond belief that this comes as a surprise. You tell Saudi, we're not going to need your oil. Saudi increases prices to the sky. But why? I mean, I'm surprised. No, it shouldn't be a surprise. Prices are going to go higher. Diesel is going to go higher. And the energy transition, like Richard was saying, good luck, right? So they're going to try and bring all this stuff and do whatever. If the energy transition didn't work in 2022 when they really needed it, it's not going to work now. Look at ESG debt. Have you ever seen like this ESG debt? It's basically gone and scraping the floor, which is telling you something about basically all this stuff to do with green and we don't need and with decarbonizing all this kind of stuff. It's honestly, it's a massive issue, and you're going to see that massive issue reflected in the price. Now, how do you get those policy changes? You get these policy changes by having massive prices and people saying, why is this happening? We've got to hide and elect different leaders. And that's it. So diesel prices are going to roof, and they're roofing because you haven't invested enough in refineries. You've sanctioned stuff that you shouldn't have sanctioned. You're basically trying in every single way to mess with the market and saying to the market that, you know what, really the 90 years plus of investment that we've made is basically useless and you're useless and we don't need you anymore and all this kind of stuff. Fine. The response of the market is, it's going to go so high, you're going to be crying. So again, it's at this. It's like these. It's like that first slap that you get. You kind of look with like open eyes, like oh, and then the tears come. So we've just about got to the slap. So tears are going to come.
Kate, diesel inevitably will put tears in certain people's eyes because, of course, it is where the rubber meets the road, and crude is obviously the raw material, but diesel is what we all buy and use, and is the backbone of economies. It's surging into this period of time. Your thoughts on the outlook for that to continue and the impact?
Me?
Sorry, I'm going to have to
Okay.
move because my internet here is starting.
Okay, we'll give that to Richard for final word. Richard, because obviously one would think.
No, I was going to say, actually,
Sorry,
I wanted to
Kate.
correct something. I wanted to correct some. Oops, sorry, I was going to correct something I said. I think I said that 2014 we would flip into a deficit, actually a surplus. That's the expectation. Sorry, no, I just wanted to add on the diesel stuff. I had to change rooms because the internet started going. It's not just the sanctions on the diesel front. It's also the fact that we've shut down a lot of refineries. I mean, between 2020 and 2022, 2022 was a good year for refineries, but we also shut down about 4 million barrels a day of refining capacity. Now, some new capacity is coming on, but it's going to take years. So I think that is one of the problems. If you look at the latest issue of MEIS, you will see that even Qatar, which is not known as a big exporter of refined product, is exporting a lot of diesel distillates. So the market is shifting. And I think when you look at the price of oil, it's not just crude oil. It's not crude oil that we use, it's product. So it's gasoline, it's jet fuel, it's diesel. So all of these demand is going up. So there you go.
The last word, Richard, to you on that. I mean, ultimately, sort of a follow-on from the last question, the continuous fight against inflation. The narrative generally has been we're getting to peak and plateau, and the markets are forecasting decline in the second quarter of next year already. But with this sort of scale of rise in diesel and its impact on economic costs across the sort of production and manufacturing and transport of heavy vehicles, you would have to think inflation goes back into the red zone.
Going to go back into the red zone. In California, gasoline now is approaching $6 a gallon. They've closed 12% of refined capacity to make biodiesel. So Marathon and P66 have closed 2 refineries that make gasoline and diesel, and now they're going to make from 210,000 barrels of refined product they were making. They're now at some going to be making about 70,000 barrels of biodiesel coming from bio waste. You cannot make this up. You cannot make up what they're trying to do. So the laws that they're putting in place, California wants battery powered trucks. The batteries, they weigh 6,000 pounds. You're seeing all this happen. And what's happening is the transition is running into reality. And so we could want all this we want, but it's going to continue in one direction. And I think what will happen is people who have voted for this will get pushed out of office and will come to a screeching halt. So I think that's the only way, even though when you look at the prices that people are paying, they're paying more for the utilities. You see what's happening in the UK. Diesel prices there are going to go up again. So this is very inflationary. I don't think it's stopping. All of these things that they are doing as it relates to energy and the transition are inflationary, because what we're seeing, I don't switch over to the UK for a second, but I just read a statistic. In the UK, the energy bill now is capped at £3,500 a year. Last year it was $1,970. The year before it was $1,200. Next year it's going to be $4,000. That's going to be printed money to prevent people from paying that amount for their energy, which the government caused to start with because they closed down all the plants that make the energy before that. So I think what you've set up here, Sean, with this ability to talk about this is very important. But I think the focus really should become is, what about this transition? Is it working? What are we going to do to get out of it? Because everybody seems to want to be in the middle of it.
Well, one thing we're in the middle of right now is a diesel shortage, and the Russians have indicated their intention to cut back on exports, and the Chinese as well. And so while Brent may or may not be at elevated prices, $90 doesn't seem to be too high, but inevitably diesel at levels where it's at is really is going to be the big impact, I think, in terms of what it means for this week alone. We've got 3 or 4 central banks meeting to announce their next steps. The Bank of England and China and others. So be interested to see where they go and where this inflation story resurfaces as the diesel price keeps going. But that's where we'll leave it today. Kate Durian, thank you so much. Omar Najia is always awesome. Richard Radoglia in beautiful Southern California. We wish we had your life, but we have a version, as you say. We're all very privileged in that respect relative
Thank
to
you, Sean.
some of the challenging places. All the best. Have a great week. Thank you.
Take care.